All right. Good morning, everybody. Hope y'all had a good weekend. We have a lot this week, really. I mean, just with FOMC and triple witching, that would be enough. We're still seeing energy costs go up. Still a lot going on with the war or conflict or whatever you want to call it. So there's no end in sight to any of that at this point. The longer the strait stays closed, the more likely it is that we're going to see something break. You know, economists try to anticipate everything that can go wrong, and oftentimes they will price in what they see happening and try to get ahead of it. But it's not the known things that break stuff. It never has been, right? It's always the surprise because if we can see it coming, we can hedge into it. We know what to worry about. And the crazy thing about the market is no matter how bad it is, as long as they know about it, things usually aren't that bad. Not to say that we can't go down when things are bad. We would, but it would be slow, controlled, steady. We just grind lower, right? Think of a typical bear market like 2002. It's the unknown unknowns that get us, that shock and awe hits the market, and we get these flash crash scenarios where things break. Throughout history, it's happened, it will happen again because there's just too many variables. Some of it gets complex and then something breaks. So continue to monitor the headlines, keep your eye on the Strait of Hormuz. Any headlines about the news, be careful of fake news. We know the energy secretary tweeted out some statement about escorting ships through the strait. The markets reacted to that, and then he went and deleted it. And the markets reacted to that too. So there's some shenanigans and manipulation going on. That's not new either. It's always been a part of what we have to deal with. This administration is, not unique in that regard. But until something changes with confirmation, then we're just looking to see things get worse. And if it stays elevated in this conflict long enough, something is going to break. And that's just what we want to continue to focus on. Today is mostly going to be digesting the weekend drama and is very likely going to be the start of a hurry up and wait scenario. It's a phrase that I used for years now. It kind of suits. We see the market get all wound up like it's ready to do something, and then it just sits there doing nothing, waiting on an event. Wednesday with FOMC would be bad enough. Triple witching OPEX would be bad enough. We've got them both. So we could get one of those weeks, which I'll show you guys on the charts. FOMC typically is a Monday and Tuesday sideways, but there are examples where it wasn't. So we'll take a look at those, kind of give you an idea of what is going to happen if we did break out, where we headed. And then the base case, which is that we don't break out and we just sit tight. So this is Market Watch. This page really is only good for US economic calendar and only the biggest things on that calendar. So a lot of times you're going to come in and it won't even have anything. It'll just say something like this: none scheduled. Now we were just talking about Friday, right? A lot of stuff like OPEX. It's not listed. They don't even care. So this is the page that I go to if I'm only looking for big economic events in the US. It strips out all the smaller stuff and just focuses on the big stuff. So it's not worthless. It just like a think of this as if we were doing top down in charting, this would be your big picture chart. FX Street is more granular, a lot more detail. It goes around the world and it picks up a lot more off of the economic calendar. So this does capture a lot more, but it's not capturing everything. And it's important to understand no matter how many websites you visit, you won't get them all. There's too many economic data points in a single day, and that's just for the US. And we need to worry about data points from around the world. You won't get them all, but you don't have to. Governments are consistent. They'll come out with data on the half hour, on a quarter hour, or a new hour. So you can kind of anticipate that every quarter hour is an opportunity for the markets to change what they're doing, to begin to do something else because some data came out. Most of the time, it doesn't resolve anything, and it's barely more than a flash of some light volume, and then everything fades back into what we were doing. And then, of course, there's some bigger ones that we focus on: CPI, PPI, non-farm payrolls, FOMC, some auctions. We do have auctions this morning, but they're small ones. They're in the front end. You could use the IRX charting to just track those front auctions. And these don't normally provide much impact. So we don't want to ignore that we're going to get some auctions today around lunchtime. We're just not expecting to get much out of it. We got some Canadian information this morning. It's not likely to spill over into the regular trading session. So unless they throw us a curveball, and the numbers are a little off, I just still not expecting much from that. And it's going to come out the same time that we get the manufacturing survey. I think that one's the survey. And surveys are just junk, right? So this is Finance Juice. Every morning they'll give you a European market wrap. Even though Europe's not closed yet, they know that we're coming into trade, so they're giving us a snapshot of what happened in Europe in the overnight. They will also do a morning briefing, and at the end of the trading day, they'll do a US market wrap, which is useful if you're trading through the day and we get some strange move and you're like, what the heck was that? What caused that? And you go look and can't find the news that caused it. Wait till the end of the day, come in and check out their market wrap and see if they talk about whatever it is that moved the market that day. So if you scroll back, you'll find that they did one for the Asian session as well. Those market wraps and market briefings can get you pointed in the right direction too, showing you what happened in the overnight while you were asleep and then what they're looking for in the pre-market or through the trading day. And they do it for Asia, Europe, and the US. So pretty good coverage. It doesn't cost you anything to have an account at Financial Juice, and you need an account here so that you can use the filter and eliminate news that you don't want. This is a news aggregate website, so they don't report the news, they just share what they found, and they have a lot of sources. I'm kind of picky about the news. I don't want junk from CNN, CNBC, MSNBC. I don't want any of that trash. Fox. So I use the filter and I eliminate all that junk. Well, if you don't have an account, then all that trash is going to show up in there. And sure, you can use the filter without signing in and without having an account, but you'd have to use the filter every day. You'd have to go in and make those setting adjustments. Make a free account. It doesn't cost you anything. And then you can save your settings, use the filter, and you only have to do it once. We're still looking to see what's going on with the Fed and their rate regime. I seen someone over the weekend say something about a rate hike. That is not on the table. I don't know where that idea came from, but I haven't heard anything about a hike, and there's no reason to anticipate that we're going to see a hike. Is it possible? I mean, yeah, I mean, anything is theoretically possible, right? There is a percent chance, but it's so low, right? It's possible we wake up tomorrow and we're done rotating around the sun, right? I mean, we just drift off into space. Yeah, it's possible. Not likely, right? So you can come into the FedWatch tool. This is another free website, doesn't cost you anything. Just search CME Group or search FedWatch. Choose the FOMC that you're interested in, and then down below you can see the changes over the last 24 hours, the last week, or the last month. We've been keeping an eye on our current rate, which is 3.5 or 3.75. And you can see that for March, 99% chance that they leave things where they are. April, 95% chance. June, 75% chance. July, 60%. Nothing even comes close, right? Now you get into September, we're down to 50%. October, they're a lot closer, but still nothing is priced in for a rate cut. And that's what they've been unwinding. If we was to look at some of the dates and the time down here, the odds of a rate cut was higher. It was at 43%, now it's at 38. Yesterday it was at 35. Right? So they've been unwinding the odds of a rate cut over the last week. It was at 41 here, and then it dropped down to 30. Now it's kind of going back up a little bit, but still 60% chance of no cut, and that's for July. So they've been unwinding it, pushing it back. The catchphrase narrative would be higher for longer, right? That's what it's just the easiest way to sum it all up, that we're expecting to stay higher for longer. The reason that you probably aren't hearing them use that phrase is because when they were cutting, they were looking for a normalcy rate, right? But normal doesn't exist. It's a unicorn, a mythical beast. You don't know where normal is, so when they're cutting, they're just guessing on where normal is. So they slowed down, and then now they finally stopped where we're at. From here, they could cut more, but that would be on the assumption that we're going below normal. So we're not looking to see this change anytime soon. If they come in and start making any adjustments to the projections, you'll see subtle changes from 30.7 to 33, something like that, or over a 1 week period, a 10% change. This is not much. What we're looking for on a day-to-day basis is significant changes, right? Drastic changes in the numbers. You won't miss it, I promise. Unless you're not looking at all, then yeah, you're going to miss it. So you don't have to sit staring at this site all day. Just drop in once or twice a day, take a peek at it, see if the markets are unwinding anything or pricing anything in. And if they're not, then this isn't what's causing the market trouble that day. It's going to be something else. Bitcoin is up again this morning, so it sounds good, but when you go and look at the chart, it's still a beaten down turd, and it's just getting a little bit of a bump to the upside because of how far it has fallen. Don't fall into the trap of thinking that just because Bitcoin's up, everything is good or that they're willing to take risk today. Something has fallen far enough that it's time to make a move to the upside. That doesn't equate to being bullish. It's a heck of a bounce, though. The put wall rolled considerably. So we're back to levels we haven't seen for a while. Still keeping my eye on the call wall, which did not roll down with the put wall. And keep in mind, this is very likely not going to be the new location of the put wall for the new OPEX. So we're still going to have to make it through the week. And then at the end of the week, we'll see where we're at with both the call and the put wall. You can see, looking at the daily chart, we're under all of the major moving averages except the 200. We're interacting with it right now. And the 3-day. So we are primed for a surge signal. This would be a bull surge since we're underneath the market. We had our bear surge back here, except that it's all tangled up. It's where price crosses through the 3 and the 10 and then gets far enough under the 10 that it drags the 3 through the 10, and then everything fans out. You see the moving averages in that nice fork pattern. So for a bull surge, we'd need price to cross the 3 and the 10, get above the 10 far enough that it drags the 3 through the 10, and that's your bull surge. Targets would be getting back up to the 69.50 and then 70.50 because we're running 50s. All right. We are below zero gamma and the volatility trigger. So if we do attempt to make a move to the upside, we've got to deal with those options levels as well. The overnight volume was at 80,000. Typical normal average overnight volume sits in the mid 50s. We've been seeing plus 150 for like a week and a half. So having 80,000 last night, when we compare it to the 50 that we would see year after year after year, 80 seems kind of heavy. But if we compare 80,000 to the 150 and 200,000 that we've been getting for the last 10 days, it comes in kind of light. They're hedging this morning. This is additional hedging on top of the normal hedging that they already carry. And we are on the new contracts. Now, some brokers are not going to roll you. They'll expect that you're going to roll yourself. Tradeovate is one of those brokers. You can set it up to auto roll, but a lot of people don't. So what you want to do is look at the current volume on the thing that you're trading. The contract that we've been using is the H series, and we're now on the M series. And you can see H has more volume this morning, but not by much. Thinkorswim is using a continuous contract, so it just by default runs me on the M, and unless I go in and tell it otherwise, that's what it's going to do. If you're on TradingView, you can choose that contract for yourself, or you can use the continuous. And even on Tradeovate, there is a continuous. It uses the @ sign, the ampersand. So just make a watch list on Tradeovate so you can see the volume, and or just move to the M series and be done with it. This is going to cause a gap in charting. By the end of the week, maybe Tuesday at the latest of next week, depending on who you use for a broker, that gap will be resolved and you won't see a gap when you look back, right? It's just some weird little trickery of magic. They'll go in and adjust the charts and poof, the continuous contract will go from H to M and there won't be a big gap when it's all done. But right now, there is a significant gap. It's very likely that this market maker move is going to be seen every day this week. And that's because they're going to be rolling out of everything, moving into the new contracts. So um, even if they were hedging because they were worried about something, we wouldn't see it. Like FOMC, that causes hedging, additional hedging. It's likely that we're going to see this tag, and it's because of OPEX all week. So unfortunately, for the week, this tag is worthless. It's a false positive, and we can't trust that it's actual hedging and not just them rolling. We've reached the ADR half early enough, which means we can go to the other half by the end of the day. This concept is not about being bullish or bearish. If we had reached the lower edge, we'd be saying the same thing, that we could go to the upper edge. It is worth noting, however, that once we got there, we tried to leave and we came right back in again. So the way you really want to play this is, as long as we don't break that low that we've got here, call it 6,700, then we're not going to go for that lower target. I wouldn't try to aim for that unless we've got a reason to aim for it. The midpoint is 66.98, which is basically 67. And the low of this pivot right here is 67.02, pretty close to 6,700. So I would just use that as the midpoint. We break that, you've got destination trading back down to 6,600. So it's a 100-point move. Surely you can get fed somewhere in that 100 points, right? There's no reason to have to take it off the top, or even any reason to get short as we're breaking down. I don't like shorting from the hole myself. I'm sure that it will present an opportunity to participate once we've broken that low and begin working our way down to this target. Friday's mid lines up with this ADR half, close enough anyways. 67.11 cog line. Now, yesterday's Globex is smaller than the full RTH, so we'll just use the entire trading day. We don't have to make two different ones like we normally do. So break the mid, target the low, break the low, we aim for the ADR half. It's as easy as that. But if we break 7,000, I would already be aiming for the half. Just need a setup to participate at that point. I still wouldn't read that as bearish. It'd be more of just completing the wave that we've been working on, right? Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it. That's also bearish. We're above both the weekly floor pivot and the daily floor pivot and we're outside of the channels, we need to keep that. I know we were talking about looking down because we've already reached the ADR half, but the thing is, we have to get through this stuff if we're going to look for downside moves. And so far, we haven't had any luck doing that. We don't have an MDP because we've already tagged today's floor pivot. So we want to look at where the H and R lines are. S and R lines. So we've made it to R1. We started to leave but came back into it. We need to cut back down through R1 if we're going to make it back to the floor pivot. S1 is all the way down here. We would have to get through the daily, the weekly, both channels, yesterday's low, and then the ADR low, and then keep falling to get to this. That's a lot of ands down there. I'm not saying that we can't do it, but that's a tall order and a lot to ask. So down is the proper argument. I just don't see how we're going to get that done without some headlines. We don't have the market breadth to do it. Some violence in crude, elevated VIX, something like that tied to a headline or, paired with a headline, that could get us to make some kind of deeper sweep down. But we're going to need something. So keep your eye on those headlines and look for a catalyst or a driver that can send us through these structures. Otherwise, what's the argument to make us so bearish as to break through those zones? So as long as we're holding above R1, we want to target R2. That's 6811 cog line. It's another 100 points higher. And of course, to get there, we're going to need to break Friday's high and continue that advancement, and then Thursday's high, and then Tuesday's high, which is the high of last week, I believe. Then we'll get into R3. That's a lot to ask because I'm not seeing the fuel for that either. I marked a level down here just under 6,600 last week. It goes back to August 2025. In a 1 month period, we had 4 weeks with overlapping points of control on the weekly volume profile. So 2 of the weeks lined up at one spot and 2 of the weeks lined up at another spot. It creates a little bit of a channel in this area. I just marked out one spot. You could get them both, in theory. Yeah, I think I clicked it with my mouse and accidentally dragged it somewhere. So this is what we're focused on right there. Those 4 weeks, right? Now I'm overlapping these two in the center. But having all 4 marked out creates a bit of a zone. And there's nothing wrong with using a zone like this because typically it's not about some single price to the tick, right? It's usually more about an area. So that's the area that we want to focus on. We need to stay above it. We don't even want to go back and check it, test it. And it's very likely that if we break this low, which is our first higher low that we're looking at in these larger sweeps that we've been building down, 66.50 breaks, we're going to 65.50 down here. Remember, we're running 50s. So 66.50, 65.50, 64.50. You get the idea. We are working on last week's distribution. This is one of the biggest zones. Of course, it's where the point of control is at. 67.50, it's right over our head. If we continue this drive to the upside, we're going to get into that. But we're already in this zone, right? So if we get out of the zone, it thins up. We can move through thin areas quicker or easier than we can through the thick stuff. And then it starts to get built back out again up here on a front run to 68.50. That would give us a value area breakout to be able to get to that 68.50. So when we're looking down, there's so much stuff down there that is going to try to help us out. But on the other way around, there's a lot of trash overhead too. Like all of those moving averages, these footprints. There's just a lot of stuff on either side, and that makes sense. We've been in a range for a long time. We've built a lot of trash up on either end. So last week's point of control right now should be your number one focus on the upside, 67.50. It's a big round number. It's a big options level. It will become a magnet when we get near it. We'll just draw right into it. But we got to get completely out of this zone to be able to continue that move to the upside. We challenged 6,800 and they were front running it last week. We just kind of zoom in here a little bit. It's going to get ugly. This area here, they were defending that 6,800. We couldn't get into it. 67.92 cog line seemed to be about as good as we could get. There's 92. So if we do get through that point of control at 67.50 and we continue that drive to the upside, be very careful once we get into 67.85, 67.90. You should see their participation in the dome, in the queue, the pulling and stacking, the pace of the tape. If they're going to take it, they're going to have to work for it, and that means they'll leave some footprints. Otherwise, back down 67.16. We get through our own value area from this morning. Our profile out here isn't going to really be helpful yet. We haven't fleshed it out, but we'll be back down through this zone that I've got marked out. Then it just gets thin, and we'll aim for this August layer that we've got marked. $10-day, 30-minute volume profile in TPO. The point of control on both of these are a match. The TPO really doesn't look that bad at all. It's the volume profile that just looks janky. Throughout the week, we're going to cut the top off of this thing unless we get back up there. So by Friday, we'll have a narrower zone, look a bit like this. And that's if we don't expand lower than last week's low, and we don't expand higher than last week's high. It's not really a tall order on a hurry up and wait week, but there's plenty of examples of an FOMC week where we were expecting to go sideways Monday and Tuesday, and we ended up making the whole week's move on Monday and then topping it off on a Tuesday. So at this point, we're just looking to see things get cleaned up here on this time frame. We're back inside the value area, which, I'm not overly impressed with. Just keep focusing on that 68.25 point of control, because if we continue to move in that direction, we will get drawn into it. All right, because the continuous contract is trying to normalize price between the two, it's messing up my drawings here a little bit. We'll just set these up where they were. It's going to be like this for about a week, right? As long as that old contract is still in play and the new one. Remember, when you go to trade, don't use this continuous as a part of your evaluation for 2 weeks. Analyze the contract that you're going to trade and then trade that contract, obviously. The continuous isn't going to match it. So I know it's confusing. A lot of people just set out and don't mess with it at all. You do you. We don't have a new VPOC from Friday. We've already cut through that level. Thin tail on the current profile, not really helpful yet unless we break down and to get thin. We should be able to revisit Friday's low relatively easy if we break out of the value area that we've established this morning. It's that 7,000 level that we were talking about earlier. Otherwise, we've got a speed bump where our Globex is right now. It's this high zone from last week. So if we can get through that, it gets thin up into Friday's high, and then we'll deal with Thursday's levels. And there wasn't really much in Thursday's level at that elevation. So then we've got March 11 VPOC to focus on. All right. On Friday, we had a narrow range, but it wasn't set in stone yet. That's what we want to focus on. This narrow range here, in relation to last week's range, we can see that it's pretty narrow, right? Last week was a wider range than the current week. This suggests to us that we're going to have a, quote, hurry up and wait week. That breakouts will fail and will come back in, and that will hold the line into FOMC. That's the base case argument. Unfortunately, there's been plenty of examples in the past, this is an FOMC week, where we gapped up and we reached the edge of the expected move on that Monday, or we finished up on Tuesday. That's our concern this morning, or even between now and tomorrow. So base case, we're going to hold the line. Careful if we don't. Right? Careful if we just keep on pushing. The week's edge is Friday's high at this point. So if we break out of Friday's high, we're already making the week's move on a Monday. And that means we can keep right on going. I'm going to cut this short, guys. Watch the clock. Keep your eye on the news. Remember, it's a hurry up and wait mode today. Be careful, be safe. I'll see y'all tomorrow.